Wait a minute. Wait a minute. You know, this is, excuse me, a damn fine cup of coffee.
Okay. Ladies and gentlemen, we are ready to start with our next session. If I could request everybody to move back into the room. Thank you. Just do it again. Can I go stand there? I'm never going to do this cubing.
It doesn't seem to be.
Ladies and gentlemen, if we could come back into the room so that we can start with our next session.
So I've asked him to come and check it. No, it doesn't seem to be there.
Clicker to move the slides.
Like Christmas.
All right, ladies and gentlemen, let's settle down. Our panel is ready for the second session.
Governors, Deputy Ministers of Finance and colleagues, good morning. Welcome to the second session. I am excited and I hope you guys will enjoy the session. We have 3 panelists for the morning. The bios are provided and I just think we can just start with Donald with your presentation. Thank you.
All right, there we go. Thank you, Mampo, and thank you, Governor and Chris, for inviting me to be part of this conference and down to beautiful Cape Town, where the weather is much nicer than it is in Washington, D.C. Lots of things are much nicer here than Washington, D.C. these days, I guess. So Chris asked me to talk about central bank independence in the aftermath of crises, but I thought I would link independence and inflation targeting in the aftermath of crises. There is some overlap with what Claudio was talking about. He and I have had several decades-long dialogue about some of these issues. I will be talking mostly from a U.S. perspective. That's what I'm familiar with, and I think there are lessons to be drawn from the U.S. experience for others, and how independence and inflation targeting played out in the global financial crisis and in the COVID crisis, and whether there are some lessons we can learn from this. So I think the first thing to point out is I think inflation targeting and operational independence for central banks are very much interdependent and self-reinforcing. Inflation targeting strengthens operational independence. It establishes a clear goal given by the democratically elected legislature or executive. Between that clear goal is set in the democratic context, and between that and the technocratic decisions on operations to achieve that goal. The inflation target becomes a focus for transparency and accountability, holding the central bank accountable for meeting its target and explaining how it expects to get there. Independence, in my view, operational independence, is necessary to hit that inflation target. We have lots of experience all over the world, and including in the U.S., where central banks under heavy political influence tend to have higher inflation rates, higher and unstable inflation rates. We certainly saw that in the 1970s in the United States. Crises test inflation targeting and independence. The goals may take a while to reach. It certainly did after the global financial crisis. We had low inflation and high unemployment for quite a while, drawing into question the competence of the central bank and the value of the targets. There are times when the targets could be in conflict. Remember, the Federal Reserve, the U.S., has a dual mandate, maximum employment and stable prices. And when those things come in conflict, growth and price stability can come in conflict, particularly to outside supply type shocks, and that certainly happened in COVID. And I think that tested the independence and the inflation targeting process. I think unconventional policies, which often happen after crises, certainly happen after COVID and the global financial crisis, are necessary in my view to hit targets, but they are not well understood. And crises, we certainly saw this in the United States. Crises and the lack of hitting those targets accentuate the partisan divides and draw monetary policy into a more partisan discussion. So let's talk about the global financial crisis. I think to get there, I'll talk a little bit about inflation targeting in the United States for just a few minutes. To some extent, this tracks my own personal intellectual journey. In the Great Moderation, inflation targeting was implicit. So as Claudio mentioned, Paul Volcker and Alan Greenspan defined price stability as inflation low enough that it doesn't have to factor into the decisions of households and businesses. They can ignore it. We also, the Volcker and Greenspan very much emphasized that getting inflation down, getting to price stability was the precondition for maximum employment. Inflation targeting was implicit in these years, so the Fed did not publish an inflation target literally until 2012. In 2009, we published, and I was part of this, published a long-term projection for inflation, which just happened to be 2%. And then in 2012, they actually adopted the 2% inflation targeting. My intellectual journey here was I was very comfortable with implicit inflation targeting. I thought we were realizing our goals without paying some of the price of lack of flexibility. But the problem that happened after the global financial crisis is we wanted to use very aggressive, unconventional policies. There were worries about what that would do to inflation, whether the Fed would be giving up on its price stability target. So I thought at that point, my colleague, Mr. Bernanke, convinced me that explicit inflation targeting was the right thing to do because it could facilitate more aggressive monetary easing if people saw that there was a target and you were going to hit it. And I think inflation targeting drove the framework changes we saw in 2020. We had a period of low inflation, below target, slow recovery from the global financial crisis. There was a deflationary bias in the low inflation, low nominal interest rate environment we were in, and the Federal Reserve changed its framework, its strategy for achieving price stability and maximum employment to take account of that low nominal interest rate target. Low nominal interest rate environment, adopting a couple of aspects that gave a slightly inflationary bias to its strategy. It would average over the target if it had been averaging under the target, but not vice versa. And it would pay attention to shortfalls of employment from full employment, but not to overage. So it put a slight, to counter the disinflationary bias of the low interest rate and the nearness of the zero lower bound, it put an inflationary bias in its framework. There were threats to independence post the global financial crisis. There was misunderstanding of QE, I think, and the nature of QE. There were inflation fears. The Fed's balance sheet was growing very, very rapidly as we purchased securities. This happened in other central banks also. And it gave rise to people who had a sort of residual monetarist outlook. They said, with the balance sheet growing so rapidly, surely inflation will follow. That's what we've been taught. So there were concerns about inflation. There were allegations that buying government securities was facilitating irresponsible fiscal policy. It compromised independence, and that played into the polarization. There was a letter sent from the congressional leadership to Chairman Bernanke advocating against more QE in about 2012. So I think there were threats to independence. There were threats to the zero rates we were running, or proposals to legislate more rule-based policies at a time when a Taylor rule would have dictated a slightly higher rate. And then we had the first coming of Donald Trump, in which he loudly disagreed with the Federal Reserve's policy, advocated for lower rates. I think these are sort of conventional political pressures, but he also ruminated a bit about whether he could fire Jay Powell. So I think he was pushing. This was a threat to independence that came out of the aftermath of the global financial crisis. And then we got to the COVID situation. There, I think, in the United States, as in most other central banks, the challenge was the inflation overshoot. This was a very complex mixture of demand and supply shocks. The supply shocks were very obvious: disruptions of supply chains, a substantial decline in the United States, anyhow, in labor force participation by people who were over 65. We're not going to go out there and work and supply our labor when the health challenges were so difficult. So there was quite a bit of cutback in supply, but there was also a big increase in demand, pushed by a very expansive fiscal policy as well as very expansive monetary policy. Part of the problem here was forecast misses. The Federal Reserve and many economists, myself included, expected that inflation impulse in 2021 would fade pretty fast. Even as late as December 2021, many economists were predicting that 2022 inflation would return to 2% or very close to 2% by the end of 2022. So there were forecast misses. I think in this case, partly this was the Fed, remember, team transitory, so these supply shocks would be transitory, didn't focus as much as it should have on the demand side. So the supply shocks weren't as transitory as people thought. The demand side was very strong. You could see this in the labor markets, very high level of vacancies relative to people seeking jobs. And then you had the complications of that framework change I mentioned to you about 2020. So in 2020, as I said, they put in some inflationary biases into their strategy framework in order to counter the disinflationary bias of the zero lower bound. And I think that complicated their response to the high inflation. They came out of a world where inflation was too low. I can remember one press conference where a reporter was pressing Chair Powell on whether the world had changed, and he said, these long-term issues about low R-star, low inflation don't change on a dime. Well, they did change, and I think that contributed to a delayed response to the high inflation. But I also, and that delayed response and the high inflation contributed to some decline in confidence in the central bank and the technocrats running monetary policy. So I do think that this very complex post-COVID situation just emphasizes the importance of operational independence in this kind of complex circumstances, like supply shocks, where you could have trade-offs between, in the short run, in order to achieve long-run goals. So you might have a little more inflation, a little less growth in the short run in response to an adverse supply shock in order to get that price stability in the long run. And making those very difficult decisions about trade-offs and where to take the trade-offs, I think requires a good bit of operational independence to achieve the goal. And then it also requires, in my mind, I think the inflation target was really important to the Federal Reserve coming out of COVID. Finally, when they finally said, this isn't transitory, we've got to get inflation down, and you can still see it in the rhetoric and the transparency, the discussions of the Federal Reserve, that 2% target, I think, sat there as a guide that helped the Federal Reserve be very aggressive, finally, in moving against inflation. So I think the inflation target and the independence were both very important to basically correcting the situation that we came out of COVID with. So what lessons have we learned here? I agree with Claudio that we're likely to face a difficult monetary policy environment going forward. We see already adverse supply shocks and the threats of adverse supply shocks from the tariffs threatened by the Trump administration. We see pushback on global supply chain integration across the globe, so some reduced globalization, demographic pressures, downward demographic pressures on labor forces. So as he mentioned, some of the forces that helped the disinflation in the 90s, in the 80s, and the 90s, and the 2000s will be going into reverse. So it'll be a less friendly environment. There are geopolitical volatility. Climate change has been, I know, cited by a number of central banks, including the ECB. I wonder how important that will be. But I think there will be the tailwinds that helped with the disinflation earlier are turning in potentially to headwinds, and that's going to present some difficult decisions for the Fed. We have the persistent elevated budget deficits in the United States, and it looks like in other countries too. The debt brake is coming off in Germany, putting upward pressure on interest rates, including R-star. So you've got a difficult environment, higher interest rates, at least for a while. You've got the heightened uncertainty from shifting and contradictory government policies coming out of the Trump administration. But the bias towards lower interest rates that we see from politicians is still very much there. Already, Donald Trump has said he's not going to fire Jay Powell, but he's already advocated for lower rates. It hasn't taken him about a month to go back to advocating for lower rates. And I think you have these budget considerations. So if rates are going to be higher and budget deficits are higher, that's a higher proportion of the budget that's going to have to be given to interest rates, and that's going to put pressure from the politicians. We'll see the higher interest rates, the budget deficits, interfering with their desires, in the case of the Republicans, to cut taxes, in the case of Democrats, to spend more money. So I think political pressure on the Federal Reserve is not going to be reduced at all. So I think this is going to be difficult monetary policy environment. In thinking about the lessons learned from this, I agree with some of what Claudia said, but not all of it. So I didn't really think through that carefully or that deeply about how I would change the price stability target, the inflation target. But I do think, as I've tried to emphasize, that the experience in both these crises points out the importance of retaining a price stability mandate with an explicit inflation target and the critical role of operational independence in achieving price stability. As I reflect a bit on my own role in the Federal Reserve through 2010 and the global financial crisis, and thinking about things since then, I reflect on explaining what went on and helping understand the politicians and the government, the politicians and the public understand what happened. I think we were facing a lot of misunderstanding. So I think I could have done a better job in support of Ben Bernanke, explaining why we chose the unconventional policies, how they were natural extensions of conventional policies having to do with interest rates. That is both the forward guidance about interest rates and QE, not something radically different, but extensions. I think it's really important to have a story about what you're doing and why you're doing it and how you expect the economy to operate and to go forward. This is something King and Kay in their Radical Uncertainty book emphasized, right? We all have stories in our head. As a policymaker, I would go into a meeting with a story in my head. Here's how I think the economy is evolving and why, and then listen to other arguments and see incoming information that might contradict that story. But telling that story is really important, linking the short-term developments to my long-term goals. I think the context of uncertainty and the range of outcomes too often are communication focuses on the most likely outcome, the median or the modal outcome, and less frequently on the range of potential outcomes. And I think we need to talk more about that. Ben Bernanke in his recommendations to Switi and the Bank of England suggested alternative scenarios be published for things, and I think that would be a good way of conveying that there are lots of different ways this come out. And I think finally, it's really important to communicate with the general public. I think the Federal Reserve does a pretty good job communicating with the markets and with academia. And when you survey, the Brookings, where I work now, has surveyed those folks and said, how do you think the Fed's doing? Mostly they say, we think the Fed's doing pretty well. I think we're doing a less good job communicating with the general public. And I wish the Federal Reserve and other central banks would concentrate more on getting that message out in ways that communicate the story and what the expectations are and the range of possible outcomes to the general public. It's very challenging. The Bank of England does a good job with layered communications, much better than the Fed does, but it's an important part of retaining public support for independence and inflation targeting. Thank you.
Oh, perfect. So thank you so much for having me here. And just like Donald, I'm going to say, yes, the weather helps, especially when you come from London with days and days of rain. And it's just a pity that we happen to be indoors and not enjoying the weather outside, but hopefully I can retain your interest for a bit. So my presentation follows quite naturally from what Donald just presented, but from the point of view of the UK economy. And I'm going to reflect on some of those issues that you brought about, that you came up with, which is that, for a while, monetary policy, the preoccupation was thinking about those very low inflation periods rather than about periods of high inflation. And of course, very much the tools are designed to handle those sorts of situations, thinking about domestic factors, thinking about demand-led factors, as opposed to what we ended up with, which is global supply chain disruptions as well as supply-side bottlenecks, which then ended up resulting in high inflation for a fairly long period of time. So one of my key messages is going to be that some of the toolkits that we need in central banking to be able to think about these very sort of global supply-driven shocks require some amount of changes to those toolkits. We're not very well equipped to handle some of these issues that arise when you're thinking of global supply chain disruptions, for example, with the kinds of forecasting models as well as the existing data that's available to most of us. So that's really going to be my key message, and I'm going to start to illustrate that with the recent inflationary episode that happened. So I'm going to start with the UK, I'm going to focus on the UK experience since the pandemic. Just by way of introduction, I came in after the Ukraine war, so a lot of the stuff that Donald's touched upon, which is the forecast misses and all of that, I saw some of it, but hopefully by the time I'd come in, I want to believe that some of those things had started to change, things had moved on from there. So one of the key factors that I think was really important when we were dealing with the UK inflation episode was that, yes, there were these global drivers of inflation, but the way they were interacting with domestic institutions and domestic factors was actually quite different across different regions. And I think the complexity of that was not particularly well accounted for early on because we had to make those sorts of analysis, those sorts of assessments in real time. And a lot of the standard measures that help you determine those things about what is it that's driving inflation, how is the inflationary dynamic going to unfold, you need sort of measures that are not the standard measures that we were relying on for underlying inflation. So I'm going to show you a little bit of that, and then from there I'm going to talk about what are the future developments, particularly on the geopolitical side with the trade policy and trade policy uncertainty that's happening. What are the impacts of that for countries like the UK, which are third countries, not directly necessarily involved in the trade wars, but otherwise impacted by them more globally. So let me start with the first bit, which is that different countries had very different exposures to the global drivers of inflation, and that in turn interacted with what happened domestically. So here, sort of on the leftmost panel, what you can see is household energy bills in the UK, in the US, and the Euro area. And of course, coming from the UK, what I'm trying to point out to you is that the shock was much greater for the UK economy. And actually, this was a result both of the fact that the energy price shock itself was much sharper in the UK because of its much higher reliance on gas, and also that the exposure of the economy in general to energy was much greater than even the Euro area, even though you might think they're fairly similar in terms of the sorts of economic structures that exist. For the US, there almost was a very, very muted supply shock compared to what happened in the UK and the Euro area, largely because the US is an energy exporter on net. If you also look at then household consumption and how that evolved post-pandemic in all of these different regions, the US does look very different, and largely you can think about the demand-led story there much more easily than what you can for the Euro area or the UK, which is that you see this very sharp contraction in consumption during the pandemic period. It bounces back, but not fully. At least in the UK case, it's not fully recovered even sort of many, many months afterwards. If you look at then also what happened on the employment side, and I think that's something which we're probably going to see years and years of people writing papers about this, trying to understand how the bounce back from the pandemic interacted with the very sort of sharp increase in supply chain driven inflation, and how those two factors then ended up translating into wage price dynamics. For the US, I mean, yes, clearly there was a very sharp impulse in terms of consumption, both led by fiscal policy, demand factors, all of those various other factors. But in the UK and the Euro area, somewhat more muted increases, but still a lot of churn in terms of how the economy bounced back from the pandemic in a very short period of time, and the sorts of wage price dynamics that came in as a result of that context. So the next thing I want to sort of try and convince you is that not only were these global drivers interacting with domestic factors, there was also sort of the underlying measures that we were looking at for inflation were not necessarily designed to think about these sorts of situations where you get really sharp supply shocks. So here's sort of my version of trying to do inflation decomposition into its various components. So it's a very simple idea. Price is equal to cost plus margins. Most of us don't really have good measures of margins, or we don't think they necessarily reflect economic profits as we would like to measure. But we can get a fairly good handle of what input costs are. On the wages side, most countries measure wages well. Most countries have very detailed supply-use tables, so we can start to trace out how much of inflation is a result of cost-push factors and how much is driven by the rest, which you can think of as margins as well. So what I'm showing you here is, on the left-hand side is the CPI basket of the UK. And we're trying to say very simply, if I look at prices and I take the entire supply-use matrix and I tell you how much is final imports, how much is final energy going into the consumption basket, and then I also start accounting for how much are the intermediate costs coming from abroad, either through global energy prices or through intermediate imports that you might be buying from abroad, which then get embedded in your own domestic production. So I'm trying to get a very straightforward accounting of all those cost factors, and then whatever I can't account for, I'm going to say, well, that's just profit or something else, the price minus cost differential. So when I first came in, a lot of what I was hearing about the energy price shock was that, yes, it's important, and UK households, about 3.5% of the consumption basket is household utilities, that mostly energy. Now, 3.5% sounds like a fairly small number. Now, add to that also, we're a small open economy in the UK. A lot of what happens in terms of food prices is stuff you're buying from abroad and therefore imported inflation. And that number, if you add in the direct final imports coming into the UK economy, was somewhere in the range of 16. So about 20% of the consumption basket you could attribute to energy and to imports that were other than energy. Now, what that didn't take into account was the fact that, particularly during this time period, let me give you an example. Bread, most of us buy it domestically. Most of us buy it from a local supermarket or from the local shop nearby. But of course, what goes into domestic bread making is stuff like wheat, which Russia and Ukraine were really important suppliers of. And none of that is really getting counted as stuff that's coming from abroad. Instead, what it was being attributed to very sort of strongly was that this must be domestically generated inflation that's then having an impact on how we calibrate monetary policy. So what this analysis tries to do is to go through the supply use tables and say, actually, can we start taking into account what is coming through the supply chain from abroad or through energy? If you do this kind of analysis, the number, that 20% number almost doubles, because so much of what is embodied in domestic production is actually coming from abroad. It's stuff we buy from abroad or stuff that we don't really have control over individually as a country, which is things like global energy prices. And once we break that down into, what happened to CPI, how much of that can we attribute to the purple and blue bars, which are the domestically generated inflation, wages, profits as a residual, and how much is stuff that's coming from abroad, then that's the orange and yellow bits, which is energy plus imports excluding energy. And you can do the same kind of analysis, and we can think that maybe core measures do a better job at picking up domestically generated inflation. Maybe services inflation give us a better idea of what is the underlying domestic inflationary pressure. And you can keep doing that based on, whatever your favorite measures are. But as it turns out, during this episode, if you look at how much was being explained in 2022 by these outside factors that weren't necessarily within our direct control, was actually fairly substantial, somewhere in the order of about 70% or so. If you move on a few more years, then we start to, the same stuff the measures of underlying inflation that we rely on start to look more in line with what we would expect, the information that we would expect them to convey to us, which is that, yes, services has a much higher share of wages and domestic factors in it, and that then tells us how much is domestically generated inflation. Overall, though, even today, because these things transmit through the supply chain and that transmission need not be immediate, we still end up with a situation where a large fraction of what we think are domestically generated inflationary measures really tell us something about what's happening to us through the rest of the world. I can also give you a broader sort of time period and do the same sort of breakdown. And again, the orange and yellow bars show you that, yes, there was a period sort of, pre-pandemic where energy and imports were, for many countries like the UK, working as almost a deflationary force, and by the end of it, come post-2020, and we end up with a situation where those same factors reverse and become really sort of large inflationary impulses. And now, of course, what's going on is a lot of that then has translated into, if you get 10% inflation, very much like Claudio mentioned, you don't end up in a high inflation regime like that and expect that somehow there won't be second round effects. It's untenable to think that a 10% inflationary, a year of 10% inflation, workers are just going to sit back and let their real wages deteriorate. So of course we see now that a lot of what's going on is to do with domestic factors. So from here, what I'm going to do is I'm going to try and sort of reflect a little bit on, what is it that how can we think about some of these other global factors that are going to start to come into play, largely because of the trade policy and trade policy uncertainty changes that are happening. My main sort of message here is going to be that all of these sort of changes to the standard toolkits that we have reflected on already during the pandemic and during the Ukraine war, those issues are going to probably not go away. At least that's what the geopolitical developments are telling us. And if anything, it's become more important and more urgent to be thinking of how those toolkits can be evolved to be able to think about these sorts of situations. And of course, the Bank of England's not the only one doing it. A lot of central banks are thinking about these reviews and what is it that we need to upgrade our toolkits, both in terms of the modeling frameworks, as well as in terms of actually collecting some of the more granular data that's going to become important, because some of these shocks are really, really specific to the particular industry or the supply chain that's under consideration. So I'm going to do the bold job of trying to take a stance on where I think this trade policy fragmentation or trade fragmentation, what impacts it's going to have on inflation activity in the UK and monetary policy. So a lot of what you may have read of on inflation as a result of the Trump tariff policies that are still sort of, I think, being shaped up. I'm not going to I'm not going to sort of try to even say where those might be headed policy-wise, but I'm going to say very much if-then statements. If policy moves in this direction, then the impacts are likely to be this. So I'm going to start with prices, and a lot of what we've read about is actually what might happen to inflation in the US, not really about what might be the impacts on third countries that are not directly participating in the trade war. So from the point of view of the UK, it's definitely one of the third countries, even though there may be retaliation and so on. But in terms of prices, I'm going to reflect first on what happened as a result of the Trump trade war when it happened in 2018. So if you look at sort of some of the more recent reports, like the World Development Report's analysis of it, import values in the US dropped, trade value in general across the world dropped, while if you look at trade quantities, they dropped less. As a result of that, the back of the envelope calculation would be that 8 to 18% was the drop in global prices that happened in 2018 when the Trump trade war took place. If you look at the UK, so thinking sort of more from the point of view of the UK, about 10% of UK imports and goods come directly from the US. So yes, you might expect that if Trump's trade war ends up making US goods more costly because it becomes harder to source those products from elsewhere, then we're going to end up seeing that directly UK import prices would be positively affected. Couple that with the fact that many people think that what's going to happen to the US dollar is that it's going to strengthen either because of monetary policy actions as a result of US inflation or simply due to changes in financial markets. So then I would say 35% of UK imports are invoiced in dollars. I'm not fully convinced that invoicing is the right metric to be used here, but for what it's worth, that's an upper bound on how much through sterling depreciation relative to the dollar, UK imports might be affected. But combine that then with the drop in global prices. So I think then my general view would be that we would expect a negative overall adjustment in UK prices because the direct reliance on import prices that's going to be positive is small, while the indirect reliance, which comes from, say, things like what happened in the last Trump trade war, that steel and aluminum steel tariffs got put on, there was a 50% drop in steel prices because Chinese exporters now needed new markets to be sending their goods to. So we end up in a situation where global prices in general see somewhat of a reduction. Add to that the fact that global activity is likely to also be negatively impacted. I'm not taking into account here what might happen on fiscal policy in the US. I think that's a very hard thing to take a stance on. But broadly speaking, at least through the trade effects, the general view seems to be that global growth would be impacted. If we think the trade ends up creating competitiveness and productivity growth, then the reversal of that should at least be negative in direction. And once again, there are particular sectors that may be very exposed to the US. In the UK, those happen to be cars and pharmaceuticals. But beyond that, in general, the trade diversion impacts are going to try and negate some of that negative impact, but they're never going to go very far enough. And that's exactly what happened during the Trump trade war, that UK exports actually did better than the rest of the world in terms of how much the UK was able to sell to the US. But overall, global exports had dropped so much that the net effect was actually negative. And finally, what does this all mean for monetary policy? I think even though it doesn't sound like the best thing to say, but an orderly fragmentation might be all right, which is to say that, policies go into place, people then retaliate to it. But if it ends up becoming something more than that, which is that the EU, the UK, the big trade partners start replicating those same fragmentation policies that the US is planning to do, we're probably going to be chasing a very few number of suppliers in a very short period of time. And that probably is then going to result in much more extreme situation of sectoral shocks, critical input supplies seeing impacts. And in that case, possibly monetary policy alone is not going to be very helpful. It's going to be a good way of anchoring expectations, but it's not going to go beyond that, just like we saw in the case of the energy crisis this time, that other policies, particularly on the energy side, had to come into play to be able to mitigate some of the negative consequences for households and businesses. Overall, as long as things move in an orderly direction, these seem like one-off adjustments that would happen that would change the general price level. But more broadly, I would say that they don't look like they're going to be necessarily things that happen that are very inflationary in terms of price growth space. I'll sort of end here with saying that if we're going to calibrate monetary policy to all of these various geopolitical developments and to a world where there are more supply shocks, more global shocks, that's going to be a much harder place to be in for all of us. And at the end of the day, what we're going to need to be able to do it better would be some really serious knowledge of what that granular data is that we need to be able to think about what the critical supply chains are, and to think sort of a little bit outside the box, which some countries have already started to do. Do you stockpile if you run out of strategic reserves? Do you do something else? So many other levers would need to be pulled in to be able to think about how to get price stability. I'll leave you with my final messages and stop here. Thank you.
Good morning, everyone. Thank you to the SARB and the organizers for the kind invitation to present in this research conference. So my name is Rafael Portillo. I'm from the research department of IMF. I'll be talking about the pandemic recovery. So there are a lot of points I want to cover. I hope I'll make it in time. First, I want to provide an overview of the pandemic period and how it compares with the pre-COVID. The emphasis there is going to be on activity, then present some stylized facts about the global inflation surge, and emphasize the sectoral aspects, which is something that has been already mentioned. And in particular, what that implies for the relationship between activity and inflation during the COVID period. As was also emphasized, these issues have important implications for the tools that we use in central banks and international organizations for the structure of our models. And so I will try to convince you that these features can be analyzed with models, existing macro models, but that the sectoral dimension is important in a way that perhaps early on or before the pandemic, the sectoral aspects of inflation were not as central. So that will be the bulk of the talk. And then I will briefly go over the monetary policy response during that time, and also try to link what the changes in the Phillips curve that we observed during this time may imply for monetary policy. My colleagues who presented before me emphasized individual countries. The evidence that I will provide is much broader for advanced economies in general, and to a lesser extent, emerging markets. So I think it is useful to, although we probably all know this to some extent, to revisit what we observed during the pandemic period. And here I am showing the behavior of some key variables following the pandemic, so from the onset of the pandemic onwards. This is for a sample of 25 advanced economies, so this is the average response for these countries. And I am comparing that behavior with the behavior of these variables during a recession in pre-COVID times. So in pre-COVID times, recessions were periods where there is a gradual decrease in activity that is persistent. As you can see, by the way, it's the blue lines. I hope you can differentiate those. Activity declines gradually. That's reflecting a decrease in demand. As a result, we have an increase in slack in the economy. You can see that in measures of the labor market, for example, the vacancy to unemployment ratio. You can also see it, for example, in suppliers' delivery time, which is, they tend to shorten because as there is slack, it takes less time to get your supplies. The behavior of these variables during the COVID period is very different. So obviously we have the partial shutdown of the economy in the second quarter of 2020. We have a reopening in the third quarter of 2020. Beyond that, there is a rapid recovery that is nonetheless incomplete so activity stays below pre-COVID trends. Now, that might suggest that there was a fair amount of slack in the economy, but as was already pointed for the case of the US, what we see during the COVID period is actually much less slack than we thought. Perhaps initially, in the initial phase of the recovery, there is some sign of slack, but quickly some of these indicators suggest actual tightening relative to pre-COVID levels. So that already there is an important difference during this period. Something that is very specific also to the pandemic recovery, as you all may recall, is the shift in spending towards goods. Here, this is the share of goods in household consumption for this group of advanced economies. That share increased by close to 4 percentage points in a matter of a few quarters. So we have these very large rotations in demand that are not observed before the COVID period. Fourth stylized fact about the pandemic period is that recovery in activity that is still below pre-COVID trends and that is associated with this large rotation in demand is then results in these very large disruptions to the supply side. And so one exhibit of that is the lengthening of supply delivery times, where firms are unable to deliver or take much longer in providing the goods that the economy is demanding. So the point I want you to take from this is that the COVID period is very different from the pre-COVID times. So in moving on to inflation, as you all know, of course, we had a global inflation surge. Inflation was truly global. The vast majority of countries experienced a pronounced increase. This is the chart on the left shows headline inflation. You see increasing inflation in advanced economies, in EMs, in low-income countries. As was also already pointed out, this surge in inflation was unexpected. The chart on the right shows forecast errors for IMF, the IMF projections, especially in 2022. So clearly, these changes in inflation were not foreseen. If we then, what I showed before was headline inflation. Now we're going to dig into core inflation, and we're going to go back to this group of advanced economies. Continuing with the comparison with the pre-COVID period, in pre-COVID recessions, we have this sustained decrease in inflation that is nonetheless quite small, and so that's consistent with the idea that Phillips curves pre-COVID were relatively flat. Instead, what we have in the COVID period is this very large rise in core inflation. And the sectoral composition, consistent with what I just discussed about the rebalancing of demand, the sectoral composition of inflation is also starkly different. So we have this very large increase in goods inflation that starts earlier, services inflation initially subdued, but then eventually rises. And what that implies is that the relative price of goods increases quite dramatically over this period. And I think this was something that was not, early on during the pandemic recovery, was not sufficiently recognized. So if we then move on to what does that imply for the relation between activity and inflation, what we see is that, continuing with this comparison with the pre-COVID period are times where Phillips curves are relatively flat. So these charts show the relation between core inflation and a measure of activity, in this case the unemployment gap. Same relation for core goods inflation and for core services inflation. So pre-COVID, Phillips curves are quite flat. Post-COVID, we see that inflation becomes much more sensitive to the recovery. So as unemployment is coming down, inflation increases much more than pre-COVID relations would suggest. And in addition, we see a shift, especially in the Phillips curve for goods. So this, of course, these changes in these structural relations pose a challenge for institutions such as central banks and international organizations. These are typically relations that are assumed to be stable in our models, of course, controlling for inflation expectations. So what I will show now is actually, I will try not to lose you with too many technical details, but just to show that actually, if you do your work and you try to replicate in our standard macro models what was specific to the pandemic recovery, that then actually you can see that the shape of the Phillips curve does depend on the type of recovery, and that is something that we can obtain in our models. So here I am comparing two sets of recovery. One, which is the blue one that you can think of as the pre-COVID relation. So what type of recoveries or recessions do we see during that time, where we see, at the risk of oversimplifying, recoveries that are balanced and that are unconstrained. And so in that case, you have movements in inflation that are not that different across sectors. Again, this is an oversimplification, and where the relative price of goods does not vary. And so the sectoral dimension of the economy is not central to understanding the inflation dynamics. Instead, when we have recoveries that are unbalanced, so where a lot of demand is tilted towards a sector, and where that sector faces a supply constraint so that it cannot meet that demand, then effectively what that implies is that firms in that sector, in that case the goods sector, are off of their Phillips curve. And so now the relative price of goods becomes much more sensitive to the recovery. As the recovery takes place, goods become relatively more expensive. And so relative goods prices become pro-cyclical. That pro-cyclicality of goods prices then has implications for the rest of the economy. Why? Because goods are used as intermediate goods in production. And so other parts of the economy, the services sector in this case, experience a greater increase in costs during the recovery than they would otherwise. And so services inflation then becomes more sensitive to the recovery, hence the steepening of the Phillips curve in that sector. And then goods inflation inherit features of both the shift in services inflation and the increase in relative goods prices, and so you have that shift and steepening. And so as a result, now we have recoveries that have very, very different implications for inflation. So if we take this model to the data and we try to replicate the surge in inflation, a lot depends on the details, but the point I would try to make is that in general, again, once you have these unbalanced and constrained dynamics or recoveries, and you also incorporate the fact that there's less slack than you might have thought initially, even though output is below trend, then in that case, these simple sectoral models can go quite far in accounting for the increase in inflation that we observe. Final point on modeling is that these tools can also be useful for thinking about disinflation. So once supply constraints become less binding, what we have is, again, very stark differences in the inflation dynamics between goods and services. We have a very rapid disinflation in the goods sector. Instead, the services sector inflation is much more gradual. Part of the reason is that once supply constraints are less binding, you end up with very high relative prices. Those relative prices need to return back to some trend. that normalization in relative prices takes place through higher services inflation. So again, thinking about inflation dynamics sectorally really helps understand what we've seen throughout the COVID period. Now, very briefly on the monetary policy response. As you all know, central banks provided considerable information early on in the pandemic. As inflation started to increase, real rates became gradually more accommodative. I think part of this stance of policy, as was already mentioned, is the belief that there was perhaps more slack than turned out to be the case, and that these changes in goods prices were a temporary supply shock instead of perhaps this more persistent pattern that I've just explained. Once this became clear, then the normalization of monetary policy is quite swift. While inflation did increase, I think we should not forget that inflation expectations on the whole, and longer-term inflation expectations remained anchored. And so I would say that the inflation targeting frameworks that underpin most of the central banks that are shown here, that are aggregated here, served its purpose. Even though inflation went up, inflation expectations remained anchored to a large degree. Another fact that we observed from that time is that even though inflation shot up, there's on the whole limited evidence of wage price spirals. And so I think the anchoring of inflation expectations also helped there. So what does this story about Phillips curves imply for monetary policy? Well, in a very simple framework, the sacrifice ratio, which is by how much activity has to go down for inflation to be reduced, when Phillips curves steepen, that sacrifice ratio is lower. So here you have a simple example where a steeper Phillips curve implies a smaller increase in unemployment to bring inflation down. What I showed you before with the model was a very simple stylized model. In the October WIO chapter 2, that takes on this subject, that chapter features a more complex model with very rich sectoral structure. What that chapter shows is that a counterfactual exercise where if monetary policy, in this case in the US, had been tightened earlier, inflation would have been somewhat lower, and the cost from that earlier tightening, according to this model, would have been relatively moderate. At the same time, of course, these were global forces, as has been emphasized already, and so the ability of any given country to fully stabilize this is limited. So, to conclude, the pandemic recovery, at the risk of stating the obvious, was very different from pre-COVID in important ways. It was rapid, unbalanced, constrained, and featuring limited slack. These features help explain why inflation went up and why the relationship between inflation and activity changed. And I think a point that has been common through these three presentations is the importance of sectoral dynamics in inflation to understand the broader, the aggregate inflation outlook. And I think that's something that is likely to endure beyond this period. Monetary policy, as the risk of stating the obvious, was accommodative initially, but the subsequent response contributed to stabilize inflation and kept inflation expectations broadly anchored. And that this is a tentative statement that perhaps these changes to the Phillips curve can reduce the cost of disinflation. All right, thank you.
Thank you so much to the panel. I think we're going to open it up for questions. Please introduce yourself, and it would be great if you can tell us who you're directing the questions to. Let's start on this side.
Thank you. I'm Guangling Liu from University of Stellenbosch. It's also known for Dave. I have a question for Donald. As we know, if the inflation is due to supply shock, we probably don't want to increase the policy rate. If it's due to demand side, we will do so. You mentioned the recent inflation that the U.S. experienced is due to both. My question is, if time could go back, do you think it's the right thing to do to aggressively hike interest rate? Because basically you can see the impact of interest rate hiking will be offset each other. If you don't have a better action in mind, that's also fine, because central banks have the only instrument, which is the policy rate, right? Another, not really question, but it is rather comment also related to your point that you mentioned Donald Trump wants to have a lower interest rate. In other words, he would prefer to have a higher inflation. That would be the concern from the fiscal side. I think in South Africa we have rather some different pressure or story here. As you were aware already, there's demand or pressure for the SARB to reconsider the inflation targeting band, maybe reduce the band. My view would be, I think the timing is quite important. Yes, we are at relatively lower inflation, 3.2, given the current inflation targeting band of 3 to 6%. However, if you think about the current physical position we have and the persistent increase of debt to GDP ratio the country is having, which is unlikely going to turn around. So if we want to have a lower inflation rate, then we will have to have a higher interest rate, which will make the fiscal position even worse, right? So I think the timing is not correct, and 3% is low, but perhaps we may have a nearly vertical Phillips curve again, then we can consider that. Any comments on that would be help the SARB to investigate the possibility and when to bring down inflation targeting. Thank you very much.
We will take the three and then we will ask the panel to respond, but please be economical with your questions.
Hello, my name is Mandisa Zavala and I'm from Alex Forbes. My question is for Rafael Portillo. I hope I understood the conclusion of your presentation. It sounded as if you were saying, given the current steeper Phillips curve, it will probably work better for monetary policy going forward because, in essence, just a small decline in unemployment would then assist with inflation. My concern was the other way around, where a small increase in unemployment would then push up inflation much more higher. So it seems as though we're essentially sitting in a level where we could essentially see inflation run away from us again. Please, can you just comment on that? And I just wanted to ask as well, just for interest's sake, maybe this is more a theoretical question, but if we were to want to go back to a less steeper Phillips curve, what would that entail?
Thank you. JF?
Thank you. Conveniently, my question was more for Swati. You referred to the different sources and drivers of inflation, including like the gross operating surplus, and there was this debate. I mean, the ECB in particular emphasized quite a lot the role of unit profit costs, where there's some opportunistic price increases. I remember at some point traveling to France and all restaurant and hotels had put up their prices by 10%. It wasn't not necessarily the cost, but it might have been following some others. Historically, we focused more on unit labor costs. I remember in my days at Salomon Brothers, he was the big bad unionized worker, was demanding wages well in excess of productivity and pushing inflation. It might still be true in some jurisdictions, but have we done enough research, or do we understand enough what drives sort of like the corporate side of the cost or unit cost, the profit element? And I remember, I think it was your colleague Hugh Pill had made some analysis saying, well, I mean, it's not just the corporate margin, might be like the mixed income and stuff like that. So my question is really like, is this something that we need to focus more in the future?
Thanks, Jeff. I think let's respond, and then we will move to this group.
Okay. So on that first question, your question was it right to raise interest rates when the Fed did? Is that in 2022? Yeah, so I think it absolutely was right. Because you had aggregate demand exceeding aggregate supply at full employment, because of the huge increase in demand, a lot from fiscal policy, but also because of easier monetary policy. And I think this goes a little bit to Claudio's points about R-star. I think there was maybe too much emphasis in the Federal Reserve on their estimate of a very long-term R-star being very low. Therefore, even if you looked at December 2021 projections, they were for very small increases in interest rates to get inflation back to 2. But there was a misunderstanding and an underestimate of the persistence of the supply shock, particularly on the labor market side. So not so much supply chain stuff, which did ease off, but the labor market participation of older people did not come back quickly. So labor force participation was lower, so the labor supply was lower, demand was pushed up by fiscal policy, and I thought the Federal Reserve paid insufficient attention to the effects of fiscal policy. There was, if I looked in the minutes to the Open Market Committee meeting for the spring of 2021, when the Biden administration passed a very aggressive fiscal policy stimulus thing, and there was barely any mention of this. They had in place forward guidance for interest rates that was conditioned on full employment and price stability, but the conditions were very odd. They said, we're going to keep nominal rates at 0 until we're at full employment. In what world, in what model, is it okay to have the highest possible real rate be -2 at full employment? The highest possible. So they were relying on, I think, flawed forward guidance. I've talked to people in the Federal Reserve who have pushed back on my theories of what happened. Was it the strategic framework review? Was it the forward guidance? And they say it was the bad predictions, the forecasts that were bad. But I think the forecasts were founded in a mindset that was not sufficiently open to the possibility of inflation, was too deeply rooted in the 2010 to 2019 period, and they didn't see what was coming. So I think they were absolutely justified in raising rates. I think they were justified in doing it aggressively, and I think that made a major contribution to bringing inflation back down, not quite to the 2% target, but close to that. You also asked a question about bringing inflation down in South Africa. I reflect a little bit on the Great Moderation period. So when Paul Volcker backed off the very tight monetary policy of 1982, inflation was still at 4 or 5%. But both Volcker and Greenspan and Claudio mentioned their definition of it had to be low enough that wasn't feeding into people's decision making. They recognized it was still too high. So how did they deal with this? How did they get inflation down? One, they kept emphasizing inflation's still too high. We are determined to get it down, or this is our goal. They leaned very hard. They had an asymmetric, this is consistent with Claudio's thing, they had an asymmetric policy response. If inflation looked like it was going to rise, they tightened. And they tightened preemptively to keep inflation from rising. So inflation was too high, but they put a ceiling on it. And then when it came down, they accepted that, put the ceiling on lower. So there was an asymmetric preemptive response to inflation, all the while saying we are going to bring inflation down. That's the route to sustainable growth. So I think it's possible to get it down. Claudio called that opportunistic disinflation, which some members of the committee did. But the key to it is the asymmetrical reaction function along with the clear goal.
Swati?
Great, thanks so much for the question. And I'm going to sort of start by saying that the usual excuse that's given, and I think it is a bit of an excuse, is that we just don't know how to measure profits. I think it's true if you want to think about levels of profits, but that's usually not what we're after. We're after profit growth. So if you have a consistent definition, in principle, you should be able to trace it and monitor it. And that's something which, fortunately, at least at the bank, after the ECB debate, we've become very, very cognizant of it. And every time anything is said about wage dynamics, at the same time, we also put in profit dynamics. And I think the reason that's particularly important is because if we want to start thinking of, when you get to that point where the goods disinflation has happened and you're really focused on services disinflation, which is really the point where many of us find ourselves in, you need to have some notion of what target consistent wage growth is or profit growth is. And typically the way, we have a lot of thinking around what that wage growth number should be for us to feel comfortable. We don't really ever think about the profit side. And at the end of the day, those two things need not move sort of in tandem with each other. So I think it's really important to be thinking about unit labor costs, as you said. The problem that we've at least faced at the bank is that, particularly post-COVID, measures of productivity have become notoriously difficult. So you might say, well, you can exclude the really problematic sectors like health, where it's very hard to pin down productivity, but you've got to do that then at the expense of saying, I'm probably going to exclude public sector productivity altogether. Those sectors I can't really look at because I just don't know how to evaluate it. Or I'm going to also try and take out some really big sectors that we care about, which are good measures of domestically generated inflation, health, education, because again, even though they may be in the private sector, they're so heavily influenced by public sector, and again, I don't know how to measure those things. So I think we get ourselves in a real conundrum about that, but I still think that is much better, even if it's badly measured, to know what those bad measurement problems are, than to just not have a measure which is beyond wage growth, which gives you some idea of what unit labor cost growth is.
Rafael?
Yeah, so thank you for your question. So what I was trying to say in the presentation is that in episodes where supply constraints are binding and demand is running against those constraints, then those are environments where inflation is going to be quite sensitive to activity. And so if you can, of course, identify when that is happening in real time, then a more active monetary policy response can be called for, at least in the sense that the cost, the output cost of bringing inflation down is lower. But of course, that is very specific to that situation. And so it's an open question whether we will see again episodes of such a steepening and shift in Phillips curves, again, because it speaks to the very unique conditions of the COVID period. Yeah.
Okay, thank you. We will move to this group, and this group, if there's any questions. Yes, ma'am.
Yeah, thank you very much. My question is to Don Cohn. It was obviously necessary for you to carry out balance sheet policy because you were the lower bound, and that was an extension of monetary stimulus. At the time, were you worried about unintended consequences of the impact of a ballooning balance sheet of the central bank on commercial banks, and what may happen as a result of that? So, I'm thinking of some of the work with Rajan and Acharya on liquidity dependence of commercial banks on ballooning central banks. So, were you worried about risks? Have these risks materialized? Would you have done it differently with hindsight? Would you have done the balance sheet expansion differently? Thank you.
Thank you.
Good morning, thank you. My question is to Swati Amtiamo from Momentum Investments. So you mentioned the differing monetary response versus whether we are in a chaotic fragmentation or orderly fragmentation. I just wanted to hear your views on the description of the two and which path you think we are heading towards. Thank you.
Thank you. On this side, only one question.
Thank you very much. I'm Monique Reed from the Research Department of the South African Reserve Bank. Donald Cohn, you spoke about the need to think about the storytelling, which I think is becoming more important by the day. We did some research where we looked at the actual newspaper articles and how they speak about inflation and monetary policy in South Africa, and reflected on the fact that there's different voices in that media article, and they speak differently about inflation. So whether our message reaches the general public, we all know most of them are not listening to us directly. The different voices speak differently. One of the things we picked up were precisely what you spoke about, the horizon. So, for example, the group that is most likely to speak with a short horizon are the financial analysts. They speak about shocks all over the place, right? So have you got any reflection for us on that? And a second thing on how to deal with that. A second thing that we notice is the content of one content-related thing, and that is that the newspaper journalists also feel the need to speak about the things that the public care about because it's demand-driven. And those things are things that sometimes central bankers don't really talk about because it's not our central mandate, especially when there are other goals. So how do we to what extent do we reflect on acknowledging those things without taking responsibility for them? Thank you.
Boipuso?
Good morning. Thank you so much for the reflections, a really interesting conversation. I'm Boipuso, I work at the Treasury. I have two questions, but I think the first one has already been partially answered. And in the interest of full disclosure, a lot of comments have spoken about the budget and people's views on our ability to hold the fiscal trajectory. So, if anyone wants to come and find us, there's a row here of fiscal policymakers, and we can share our views and feelings around where we find ourselves. But more seriously, I think the observation around communication is a critically important one. And Donald, you spoke about it, and I thought it was very interesting. The previous comment starts to touch on it, but I'm curious about what you find to be effective communication, particularly for an audience that isn't necessarily one that you would very easily speak to, your sort of core constituents. How do you speak? What do you find has worked effectively to speak to an audience that's broader and sort of that whose consequences of macroeconomic policy are sort of more tangible to them, if that makes sense, right? As you were saying, sort of the general public. How do you communicate more effectively on these macroeconomic policy issues with the general public, in your view? The second question is to Swati, and I thought your third category of things regarding macroeconomic toolkits, yes, you're speaking from a monetary policy context, but I think they also sort of apply from a fiscal policy perspective. I'm curious about what you found to be effective in your ability to adapt the toolkits that you have in order to deal with counterintuitive or somewhat unusual consequences. We've had quite a few sort of lived experiences in this regard. 2019, half of GDP growth was essentially wiped out because of electricity supply in the South African context, which is not a thing that you would necessarily find intuitively in a macroeconomic model, but it's a critical consideration when you think about how you project. So I'd be curious to find what your experiences were, what you found worked well, what you think didn't work well, and sort of, yeah, how you approach that space. Thank you so much.
Thanks, Bipuso. Gav?
Mine is a policy question. And Donald, you talked about goal setting, but there seems to be confusion between goal setting and target setting. And I'm trying to make sure that it's clear. Society sets a goal. The goal is price stability or maximum employment or both in the case of the US. The Fed sets this 2% target. What's the role of the Treasury? What's the role of Congress? That these technocrats just meet in the FOMC and decide that this is the target. And it just strikes me that there is a target, clear, explicit target for inflation. There isn't one for employment. If you could help me with that. And you said it's dual mandate. When I read the Fed statute, it looks like you have got a triple mandate because it says price stability, maximum employment, and then there is one that you never talk about, which is low long-term interest rates, which sounds to be an interesting dynamic that gets brought in. When I talk to some people at the Fed, it's embedded in the price stability a mandate. But the point is that I'm sitting with my two colleagues here. They are politicians. Politicians are all elected by borrowers, so they prefer low interest rates.
Thanks, Gav. We'll just take the last question.
Lumke Mondi from Vets. I'm just going to repeat what has been said, but I'll say it directly. In deeply divided racial and class societies, how do you communicate the excellent work that you do in inflation targeting? And so my colleagues have asked it, but I'm making it specific because in South Africa, I think part of it is the deep levels of division class-wise and racial divide. And how do you communicate this policy? Thank you. Yeah.
Thank you so much for the question. I will allow the panel to respond. Because this will be the last response, in your response, please also add any critical messages that you think the teams must take home. And you can also respond to some of the questions, even though they were not directed to you, but you have something to contribute, please do go ahead. Donald, let's start with you.
Want me to start? So in terms of unintended consequences from QE, no, I didn't have those in mind when we initiated this in the fall of in November, December, January 2008, 2009. I think it was an economic emergency, and we just wanted to restore market functioning and get interest rates down to turn the economy around out of a very bad thing. In retrospect, I'm not even sure I believe the Rajan thing that this had a huge influence on commercial bank liquidity provision. But even if it did, I'd prefer to use my prudential supervisory tools. If I thought commercial banks were providing too much liquidity and putting themselves and the system at risk, I have a whole tool kit in supervision and regulation I can use to do something about that. So this is not, I mean, Claudio talked about using monetary policy for that, but I would, and this is a conversation Claudio and I have had over several decades, But I would make monetary policy a last resort. So living with low inflation or a recession in order to avoid a future financial cycle. I think we have other tools to deal with that. If they didn't work, then I'd turn to monetary policy on that. So I think there were a couple questions having to do with the stories we tell and how we tell them. One danger is central banks taking responsibility for things they don't have control over. And I think to some extent the Fed got into that in the late 20-teens. And they talked about, when they changed the framework in 2020, they talked about helping certain demographic groups, disadvantaged folks. And those are worthy goals that I actually share. But monetary policy is really hard to do. And that's restoring price stability and keeping employment and growth on an even track is extremely difficult. We, the central bankers, I still say we, even though I've been out for 14 years, don't have the tools to aim at various groups. And I think it's not good to try, because you end up, or not good to use that language, you end up raising expectations that you can't fulfill. So I think the stories have to be aimed at the macro economy. That's what you can do, while acknowledging there may be other issues, but they're just not under your control. So I think, Governor, your question was about the 2% target and how it arrived at and how it's justified. So I think partly, and then the low long-term rates. So I think it's actually unfortunate that I think 2% is a pretty good target. It's low enough that it doesn't figure in people's decisions. I wish the Federal Reserve would spend some time justifying it. Instead of just saying, that's our target, here it is. We have academics who say it should be higher in order to get more room at the zero lower bound. The public thinks it should be zero. Why do I have to live with the price level doubling every 36 years at a 2% inflation rate? Why can't I have zero? And I think we have good answers to that about downward rigidities in wages and having, a little bit of inflation grease the wheels and having nominal interest rates be high enough to deal with negative shocks. I think the central bank should do a better job of justifying how they got to 2, other than history got us there. And that, by doing that, I think it would help to reinforce the commitment to price stability, to keeping inflation down that low. And then your question also was, you're correct to point out that the Federal Reserve Act says maximum employment, stable prices, and moderate long-term interest rates. You're also correct to say that the presumption has been if we get the first 2, the third will follow. So a stable economy and low inflation will produce moderate long-term interest rates. And we don't have the tools to deal with all 3 of those things separately, for sure.
Just for the benefit of South Africans, why is there an explicit inflation target and no explicit employment target?
And that is, so the question for those who couldn't hear it from the governor was, why is there explicit inflation target and not an explicit employment target? And I think the answer, which is actually contained in the strategic framework that the Fed controls, is that central banks can control inflation by regulating aggregate demand relative to aggregate supply. The unemployment rate consistent with full employment is given by lots of things in the labor market. The efficiency of job seeking and job finding, that kind of thing, which really isn't under the control of the central bank. So the central bank could say, and the Humphrey-Hawkins Act, the act in 1978 that set up the monetary policy reporting requirements, etc., said you should have a goal of, I think it said 3% inflation, 3% unemployment, but there's nothing, the Federal Reserve can't make 3% unemployment rate be consistent with price stability. So over time, the Federal Reserve has said, we don't control how the labor market works. Our job is to discover what the maximum employment is consistent with price stability. And we have the tools to do that, but not to set a goal for employment and make sure it's consistent with the price stability goal.
Thank you, Donald. Swati?
Great. I'll start with the fragmentation question. So I think at this point, we're still at a fairly orderly fragmentation, which means the US starts with its trade policy, puts on tariff barriers in this case, and then China, the EU, and others retaliate to that. That's fairly sort of systematic, that firms and businesses typically can rewire their supply chains accordingly. I think the danger here is, and I think that's a fairly extreme situation, I don't think that that's a central scenario, would be where you start to have many of the larger trade partners also go and start doing the same sorts of friendshoring policies, looking for basically a very limited set of suppliers because they want to exclude certain countries and certain trade partners. If that happens, you can't adjust to that quickly enough. So then I think there's a serious risk that would pose severe inflationary pressures, if not at a very broad-based level. I find that hard to believe. I think it would be broad-based, that it would at least be very concentrated price spikes. But I think we're not quite at that point. On the other question about what are toolkits that might be useful, so one thing that we did have to go was to go off-model in many cases, and it was particularly useful when it came to the labor market because most of the forecasting apparatus, it's really in the labor market statistics that they tend to have much bigger forecast misses. This inflationary episode notwithstanding, I mean, more broadly speaking. And there, let me give you one example if that might help to fix ideas. So one of the things that early on was going on in the UK, as well as to some degree in the US as well, that, there's been a lot of inactivity that's taken place as a result of the pandemic. People are dropping out of the labor supply, and that might be one reason why we're seeing the kind of wage growth that we're seeing. Now, that's actually somewhat easy to check because across at least many of the advanced economies, people are moving across regions very much, and definitely not the people who are going into inactivity. Typically, they tend to be very fixed to where they are. And if you looked across different regions, so in our case, we looked across the travel to work areas in the UK and saw regional wage growth correlated with the rise in inactivity that's happened. I mean, the line is so flat that you would really have to come up with some absurd numbers of inactivity to be able to explain the kind of wage growth we were seeing. So in that sense, those were the sorts of things which were really helpful in ruling out some of these explanations that we were seeing crop up in the narrative. And I think going back to the communication point, I think they have a lot of value in being able to sort of at least push back on some of the explanations that people were coming up with. Stop there.
Thank you. Raphael?
So maybe just to reiterate that, in a sense, what happened during this period is a lot of shocks, but also shocks operating through complex channels. A constellation of shocks, in some cases cutting a bit beyond the demand and supply split. Assessing the state of the economy was also quite challenging. And so perhaps a message to central banks out there is to continue investing in macro modeling, models that have sectoral richness for thinking structurally about these shocks, how they propagate through the economy. Because I think the shocks that we might see going forward, although they may not be as large, they may have some of these elements. And so better understanding of these issues is I think is going to be a fruitful area of work for central banks and international organizations.
Thank you so much. Good people, thank you for this session. I have my own list of questions that I'll ask during lunch. You are free and welcome to engage with the panel during lunch, which will take place from now until 2 o'clock. And you go out to your left for lunch. But thank you so much. See you back at 2 o'clock.